Howdy, folks. Welcome to the Daily Coin. My name is Rory, and today is Thursday, January the 3rd, 2018. I have the very distinct honor and great pleasure of welcoming back a person who I really respect his work and I really respect what he's doing. And he is the chief analyst and opportunity researcher for PortfolioWealthGlobal.com. And it is David Moadel. And David is also he is also active on multiple social media platforms with tens of thousands of followers on YouTube, Twitter, StockTwits, and other popular sites. David, welcome back to the Daily Coin.
It's great to be back. Mr. Rory Hall, thank you so much for bringing me back. I love what you do. I love the message you're sending out to the people. It's a necessary message, and I'm looking forward to speaking with you again today.
Well, I certainly appreciate it. You can see all of David's bios up there, right there on the screen. And David, I wanted something that I've spoken about for the past 2, maybe even 3 years, is an economic depression. I think that if you just barely peek behind the curtain of this mirage that we're sold as being economic recovery, that you would see nothing but rot. I think that you see that everywhere, and it's really starting to creep into even the mainstream, not mainstream, but the corporate media narrative. It's really getting very difficult to hide any longer. What do you think? I mean, am I wrong in calling it an economic depression? Or because people are saying, well, we're easing up on a recession. It's like we blew past that a long time ago.
Yeah, recovery. What recovery? Okay, recovery should be in big quote fingers. Okay, exactly. You can't see my fingers right. You can't see my fingers right now because this is audio, but I'm making big quote fingers around the word recovery, which never really happened. The jobs that came back. Don't you love how the government, and this is true of the previous administration and this one, they all do it. They fudge the numbers or massage the numbers so much. Unemployment in the 3s. Really? Come on. What is the real unemployment number? Why don't we go ahead and include people who left the workforce because they just gave up on looking because they couldn't find a job month after month, year after year? Let's include them in the jobs numbers, shall we? How about if we include people with part-time jobs, okay? A person who is working 10 hours a week should not be counted as employed by the government. How about people who are, they're employed, but they're not making a living wage? Because just because they're employed doesn't mean that they're making something that they can really live off of, especially if they have a family. So what they do is they fudge the numbers and they make the economic numbers look better than they are. Every administration does this whenever they get a chance. So, it's not a political statement on any particular administration. Recovery, the jobs came back. They came back to China. Exactly. They came back to India. And nothing against those countries. Those individuals should deserve to work as well. But they're not being paid a living wage. And yes, we wanted to bring the jobs back to America. And we did, but not necessarily the ones that really that are survivable, that are livable. Okay. So recovery, I say what recovery? Pensioners, savers, retirees, they're still having to invest in a market that is overpriced, even after this recent 20% correction, which technically was a bear market, but it was nothing. That was just a warning shot. You have a very sophisticated audience, which is why I love coming on this show. And I can speak in these terms. I can use terms like bear market because you know what it means. Many people have been investing, listening to this program, have been investing since 2008 or since 2000. And you know that in a bear market, a real bear market, there are, drops and then what they call dead cat bounces. There are these bounces like we saw in the final week of 2018, where the stock market goes back up 5, 6, 8, 10%. You remember that day just about a week ago when the S&P 500 went up 5% in one day? That was insane. That was a crazy day. It looked bullish. It's not. Those type of moves are not healthy. That you didn't see that kind of move in 2011, 12, 13, 14, 15, and 16 in those more normal years. You saw a steady grind upward, a very calm market. We still have an elevated VIX because the options and futures traders know that it's still very volatile and that this could just be a dead cat bounce. I believe it will be, even in 2008, even in that 50 or more percent decline that happened. There were vicious rallies in there. I think we saw that in the final week of 2018. We'll see more of those, but the net result will be, like you say, a depression, yes, or at least a recession. Something terrible this way comes. You see it coming. I see it coming. I hope everybody else does too.
I think we're right in the middle of it. I think we're in the
Yeah.
thick of it, and like I said, you pull the curtain back just a little bit, and you
Mm-hmm.
see nothing but rot. I mean, just like you
Mm-hmm.
said, the unemployment in the threes, not according to John Williams over at Shadow Stats, who uses
Yeah.
an alternative formula to the nonsense that we're sold as reality. We know that
Mm-hmm.
it's all a mirage, an
Yeah.
illusion.
Yeah.
And speaking of which, I mean, President Trump is now faced with, beginning today, and we're recording this on Tuesday, but beginning today or we're recording this on Wednesday, I should say, beginning on Thursday, January the 3rd, Trump will now face a new nemesis, a new attack, and even more of an uphill battle than the one
Yeah.
that he's been faced with for the previous 2 years. I mean, how do you see that playing out in regards to the economy? I mean, is the economy going to be put on the back burner? Is it going to be the one rallying cry that he's going to be left with, or what do you see happening there?
I see it leading to increased division in America. The divisiveness, I haven't seen this. If we look through history, we could look at the Civil War. Okay. We can see other times in history. We can see the riots of the 1960s. This, I believe, what we're seeing now is on par with that. And now that we're going to have a non-unified House and President, okay, the chambers of the United States government will be divided now. I think that will increase the divisiveness. I think it's just going to get worse. And division is not good for the nation. I'm not blaming either party. I'm just saying it's not good for the country, and it's certainly not good for the economy. None of this is going to help Main Street. It's not going to help the you and me, the
Right.
savers, the investors, the retirees. I believe that we need to get into alternative assets and quickly. And I know that's one of the foundations of your program is not putting it all into the stock market and just trusting, or worse yet, handing over your money to a fund manager or money manager, going into your local bank and just giving over your money, saying, okay, do whatever you think is right, and charge me 1 to 2% of my money every year for this privilege. I'm using the quote fingers again, even if you can't see it. Look, again, I believe it was a warning shot. What we saw, the 20% correction in the S&P 500, and that was with a unified government. With a divided government, I think the rhetoric is going to get stronger. I think you're going to see more. I mean, Trump, say what you will about him, but he's not one to hold back. Okay,
No.
and he didn't hold back when there was a unified government. How do you think it's going to be when there's a divided government now, when the House is majority Democrat and we have Trump in the White House for the next 2 years at least? What's that going to look like for the next 2 years, and how is that going to impact the economy? Well, and we talked before we started recording about the possibility of Jerome Powell losing his job.
Yep.
That is a distinct possibility. I'm amazed that he's held on, been able to hold on as long as he has. If he gets fired, and remember, this is a president who had a reality show where you remember what his catchphrase was, right?
Right.
You're fired. And that's what people love about him. A lot of people love about him is that he's blunt like that, and he's not afraid to get rid of somebody if he feels they're not performing or is not in line with his overall strategy and philosophy.
Exactly.
which Jerome Powell is not. To save his own job, or attempt to save his own job, he cut the number of expected rate hikes from, for 2019 from 4 to 2. He cut it in half. Trump still didn't like that. Nothing's going to be good enough except for maybe a rate cut or multiple rate cuts. And I don't see it. Jerome Powell doesn't have that personality type from what we've seen. So if there is a firing, or even if he just quits on his own, even if he just resigns, the impact, the shock to the markets, that's something we just don't see. People in that position suddenly resigning or getting fired. It just doesn't happen like that. So the shock that will happen, if you're not protected before then, the time to protect yourself is not when that happens. Then it's too late. Then whatever economic turmoil we have will just get worse. And whatever positions you have, if you have an index fund, whatever you have, regardless of what Jack Bogle tells us, nice guy, okay, well intentioned, but just investing in an index fund, it's going to get you killed in 2019. I don't even think it'll take that long. I think in the first quarter of 2019 will be very dangerous for index funds. And we have a report about that at portfoliowealthglobal.com. First of all, we have the newsletter over there. Feel free to everybody put your email address in and get that newsletter. It's a top-rated one, and we've made a lot of money for a lot of people. But portfoliowealthglobal.com/crash, we have ideas on how people can protect themselves throughout 2019. And as I mentioned, in that first quarter, I don't think it'll take long before things take a turn for the worse, much worse.
Now, what do you see for bonds? Now, you were just talking about the stock market and the equities. What do you? How do you see the bonds with the situation, with the turmoil that we're faced with the potential? Who knows what's going to happen with Jerome Powell? And be perfectly honest, I hope they fire him. I hope that Trump does fire him. I hope that the markets go completely crazy.
Yeah.
Maybe that's bad on my part, but that's the way I see it. Something needs to happen.
Yeah, I don't think that is bad. I think that we have a choice. We could either, pull the Band-Aid off very, very slowly, or we could just rip it off and get it over with. I'd rather just rip off the Band-Aid and get it over with.
I'm with you.
Or it's kind of like if you're a kid and you're at summer camp and they make you jump into that cold pool, right?
Right.
Why do they never heat those pools at summer camp? At least when I was a kid, right?
Exactly.
They could have just solved the problem. But anyway, that's my own problem. There were certain kids who would dip their toe into the pool and then their leg and then their body and finally, and me, I would just jump into the pool and get it over with. Why don't we just get it over with, for goodness sake?
Exactly.
Talking about bonds, I'm glad you brought that up. The 10-year T-note is at 2.67 right now. It is fairly low. I remember, and I'm sure your audience remembers quite recently when it went up to 3, and then it was just going up and up and up. That's what Jerome Powell wanted, and still wants. He wants to raise it. And so bringing it back a little bit, again, that's for a couple reasons. Jerome Powell wanting to keep his job, okay. Not wanting to send the market into a recession, because he saw, and we all saw, what happens when you do raise rates from 0 to something more reasonable, like 5% or higher, right? Because there was a time when you could get a perfectly decent 5% yield on an annual basis if you were a retiree. Just put some of your money into U.S. bonds, and you could retire off of that. Those days are gone now. And so 2.67, that's still nothing. We're barely keeping up with inflation, which is about the same as that. And I feel that inflation is going to go up, most definitely. I think we're going to have hyperinflation in this country within the next couple of years. And so we have so many headwinds to the economy, so many headwinds to the stock market. We have tension between the president and the Fed chair. That is crazy. That is not a sustainable situation.
Right.
We have so many yield curve flattenings and inversions going right now. Pick any 2 T-notes, and they're probably either flattened or inverted right now. And look, look at what happens within the next 1 to 2 years when you get multiple flattenings and inversions of treasury notes at different time frames. It's never good. All right. You get things like the year 2000, the year 2008, 1987. You get things like that. It's quite consistent across the board. And the mainstream corporate media won't report on that. But the Daily Coin will and does. And that's why you're such a great source of information. I don't even think you're an alternative source. I think you should be the main source. And that's why we're going to continue to report on that at Portfolio Wealth Global in the newsletter and in our reports, because people need to be aware before it gets really bad. Again, I recommend portfoliowealthglobal.com/crash for the crash report. We also have a gold report, portfoliowealthglobal.com/gold playbook. And I do want to talk about gold because that is
Yes.
such a great crash hedge, such a great safe haven, a 6,000 plus year old safe haven. You're not going to find that in other assets. Okay. You're not going to find an ancient form of money that always comes back in value. Okay, yes, we did have it depegged from the dollar in 1971, the year I was born. Okay, so the year I was born, something good happened. I was born, and something bad happened. We took the United States money off of the gold standard and onto fiat currency, and the value of the dollar has gone down. Notwithstanding how it had dollar had a great year in 2018, granted, but we talked about dead cat bounces. The dollar has gone down so much since the year I was born, and it will continue to go down. Will we get to Venezuela type of hyperinflation? I don't think we'll be that far off. I don't mean to scare people, but I kind of do, because I want you to get prepared now, not later.
Exactly. I mean, because it doesn't do any good to be prepared, like you said a minute ago. It does no good to be prepared the day that it happens. You have to
Yeah.
be prepared the day before anything changes, and
Yep.
that's what we're talking about is,
Yeah.
you know, and whether it happens or not, David, I've been, collecting coins for some time now,
Hmm.
and I'm not going to stop doing that.
Yeah.
And it's I'm starting to I've been away from the digital paper assets for close to a decade.
Yeah.
Got out of the stock market, never been in bonds, and but I'm starting to look at that from a different perspective at this point, because
Yeah.
I want to have a little bit of that so that when there are these major changes or even significant changes, they don't have to be major changes, just significant. Like, a 30% change
Hmm.
is going to be enough, in my opinion, to create a lot of chaos.
Sure.
And that 30%, I want to be able to catch that 30% on the way back up, and I can't do it if I'm outside of it.
Right.
So I'm not going to be so arrogant that I don't see that. And the report that you have on the bonds on the bond market is at portfoliowealthglobal.com/bonds. And I want to
Yep.
I do want to talk about gold. I want to talk about silver also.
Sure.
And I want to start with silver actually, David. And do you in that report that you have, which is portfoliowealthglobal.com gold/gold playbook.
Right.
Now, all of these reports are free. You just have to sign up for them, and they will be delivered right to your inbox.
Hmm.
Um, is silver included in that report, or is there a separate report? And what do you see in regards to the bullion silver market versus the uh, resource or the stock silver market?
Thank you for asking that. And yeah, that report, Gold Playbook, is for all precious metals investors or people who are interested in it, people interested in protecting yourself with gold, with silver. Uh, Look, in December, gold rose by 4%. its biggest monthly advance since January of 2017, which is 2 years ago now. In the fourth quarter of 2018, gold gained 6%. Fantastic. While the S&P 500, on the other hand, lost 15%. Right now, we've got gold at 1284. We've got silver at 15. They're both fantastic. There's an old saying, the longer the base, the higher in space. You know that one, right? Well, would you consider all of 2018 to be a pretty sizable base there?
Yes.
I would. And so it is blasting off, but it's at the beginning of the blast off, which is what a great time to get in. What a great time to get into precious metals. I haven't seen an opportunity. I've been in this for a long time, and you might have been in this longer than I have, but I've been in this for a long time. It's rare that we get opportunities like this. So it's more than just a hedge. It's more than just a crisis hedge and a form of money, although it is that. It is also an investment in your future because I believe these will go up quite rapidly. Better than bonds, much better than bonds, which are toxic. And you did mention the /bonds report at portfoliowealthglobal.com. I appreciate that. Check it out. If you are thinking about getting gold or silver, it's not an either or. You can get both because right now the gold to silver ratio is at 82.5. This has only happened in the 80s, in the early 80s here. That gold to silver ratio has only happened 4 times since 1971, the year I was born, the year that the dollar was depegged from gold. So it is a rare thing. And what happens when the gold to silver ratio gets into the low 80s? After that, it generally outperforms. Silver just kicks butt after that. All right. And silver, to me, is kind of like gold's more volatile little brother. It moves a little bit faster to the downside, which it did on the way down, but it also tends to move faster to the upside. And so the gold to silver ratio doesn't stay in the lower 80s for very long. If you look at the 20-year chart, the 50-year chart, check it out, Google it, research it on your own, in addition to the research you can get from Portfolio Wealth Global. Find out what happens when it hits those extremes. The median of the gold to silver ratio is around 50. And so whenever I get extremes, I'm watching it closely and knowing that there is such a thing as mean reversion. Things tend to get back to normal. Could the gold to silver ratio get up into the 90s? Could it get closer to 100? It could, but it won't most likely stay there for very long. I'm looking at a silver bull market and a gold market as well. You can have some of both. And by the way, I talked about the fourth quarter of 2018, gold gaining 6% while the S&P lost 15%. How about the gold miners? The gold miners gained 12% in the fourth quarter of 2018.
That's awesome.
So if you want to look, if you want a little bit more leverage compared to gold, maybe gold doesn't move quite fast enough for you, that's fine. Get some silver, moves a little bit faster. It's a little bit more volatile, a little bit more risk and reward. If you want even more leverage than that, if you want quicker gains within a shorter amount of time, and again, there is greater risk as well, so don't load up on it too much, but I want you to look at the miners, the gold miners and the silver miners. So yes, I do believe in some stocks, not loading up on an index fund necessarily, but if you pick and choose your stocks carefully, which is what we do in the newsletter, the Portfolio Wealth Global newsletter, we're going to tell you about stocks that we're picking, that we're looking at, that meet and exceed all of our criteria in the mining sector or wherever we pick it from. We have a research team. I have an advantage that most people don't. I've got a whole research team behind me.
Yes, you do.
Most people don't have that. Most people are on their own using Google or whatever, using Yahoo Finance. That's cool. I use it as well, using Bloomberg. But they usually don't have a team of people who fly out to places and speak to CEOs of mining companies. Okay.
Right.
I have that on my side. And so I'm glad to spread this type of information with the newsletter, Rory, just like you're doing with your program. You're spreading information because you have access to resources and you've been in this game longer than most people. I think you would agree with that one.
Kinda, yeah. I've been around for a while.
I would imagine so. And so I've been around for a while too. And so if you're new at this game, if you're new at investing, if you're new to trading, you want to know ways to gain a little bit of leverage without taking on too much risk. I don't recommend just holding cash for too long. I believe the dollar will decline by 30% in the next 5 years. I just called it. Okay, it's on record now. And I believe that the dollar will go down over time, just like it always has. Don't let 2018 fool you. Yes, the dollar outperformed in 2018 doesn't mean it's going to happen in 2019. All right. In any decline, there are bounces. That's all that was. So protect yourself, protect yourself, protect yourself. I'm going to say it until people actually start to do it.
Exactly. Well, and I've been on record, David, since early to mid 2017 to saying that gold and silver both are going to go much higher from where they're at,
Yeah.
and that I see that beginning this year. Actually, towards the end of this year, we're going to start to see some movement. And
Yep.
then 2019 and 2020 in particular, we're going to see some real gains, in my opinion.
Right.
And by 2021 to 2023 time frame, we're going to see some very significant gains. And once they achieve these gains, they aren't coming back. They
Yeah.
will.
Yeah.
That's that, and I'm gonna keep saying it. I've been saying it, and I'm gonna keep saying it until there is other information out there that tells me that I'm wrong. But right now, there's nothing out there that says that this isn't going to happen. I'm not selling anything. I'm not
Right.
offering financial advice. I'm not a financial advisor. I'm telling you what I see for myself. And you, on the other hand, David, you have portfoliowealthglobal.com, free newsletter. You do
Mhm.
offer advice, and people should take a look at it because I mean it's free. It doesn't cost you anything at
Right.
all,
That's right.
and
That's right. And
that's
people
rare.
should. Yeah, yeah. And yeah, oh, absolutely. Well, we're spreading the information and we're kind of in an ongoing battle. Would you agree with the corporate media who doesn't
Absolutely.
report on these things? How often does the corporate media report on gold at all and
Well,
silver at all?
now here's an argument that I have. Okay,
Hmm.
you know that gold and silver both are money, have been since the beginning of money.
Hmm.
They're not currency. Well, they can be currency. They're currently not currency, but they are in fact money.
Right.
Every financial network, whether in the Western world, each one of them has a has its own little square in the at the bottom of the screen at the ticker that says gold is X number of dollars, silver is X number of dollars. They could put Apple in that square. They could put
Mhm.
Netflix in that square. They choose to put gold and silver in those squares. They give them their own. Also, the other argument that I have that gold and silver are still part of the global monetary system. If they're not, then why does each central bank around the world have gold listed as a tier one asset? A tier one asset on a central bank's uh, reserves spreadsheet is money, nothing else.
Mhm. Yeah.
There are. I don't think anything else can be listed as money under a tier one classification. I may be wrong, but
Yeah.
um,
That's a great
and
point. And
so
why are huge world powers like Russia and China and India hoarding so much gold, accumulating
exactly,
so much gold?
exactly.
You have to ask yourself these questions. They're not dumb. They're doing it for these are governments hoarding gold. What do they see that we don't? And when I say we, I really should mean the American corporate media. What are they seeing that they don't? What do they know that's coming that it's just not being reported on here? And it's out in the open. You can look it up. Again, I always tell people Google it if you don't believe me. Look at
Right.
how much gold is being hoarded by these major world powers.
Right.
Uh, yeah,
Well, and you can
they
look
see
at
the future that we don't.
some of the smaller countries like Kazakhstan, which I love to look at Kazakhstan. They have
Yeah,
they have been increasing their gold reserves for 6 years, 7 years now, and they've
yeah,
just about tripled from where they began.
right.
And they each month they and people go, well, I don't even know where Kazakhstan is. Well, let me tell you, it's a border country. It's a country that creates part of the border between China and Russia, and it is strategically it is an extremely important nation. And what they're doing is they are a major piece to the Eurasian Economic Union, which is headed by Russia, and they are
Mm,
also a major piece of the uh, Shanghai Cooperation Organization, which is headed by China. So they
right.
have a foot in these two massive economic alliance pools, and they are they are acquiring gold every
Yep.
month for the past 6 years. And you have all these other smaller nations that are doing exactly that. It just keeps going. And
Yeah.
it's not that I'm looking at and going, you know, well, they're doing it, so that must mean something. Well, they're not going to make trinkets out of it. They're not
Yeah.
making jewelry. You know what I
Right.
mean?
Right.
So,
Right. Countries like you mentioned Kazakhstan, but Russia, China, Turkey, Germany,
Turkey.
France,
Yep.
Italy,
Yep.
all shoring up their gold reserves.
Yep.
And meanwhile, the smart money in America, we've got fund managers like Jeff Gundlach, Ray Dalio. They've been augmenting their own precious metals allocations in anticipation of a multi-year bull market in gold. Again, anybody can Google this and verify what I'm saying. Look, we all wish we had bought gold at exactly 1176 back in August of 2018. Okay,
Or
it's probably
285 back 30 years
yep,
ago.
yep, exactly. It's probably a little too late to get that price again, like you mentioned. Yeah, no, I'm glad you mentioned that. When it
Yeah,
gets to a certain price, we're not going to see that again
right.
anytime soon.
Exactly.
So, but that doesn't mean so we're not waiting around. My strategy is not to wait around until it hits 1176 again. Okay.
Right.
My strategy is to look at the long-term chart. Folks, you got to pull back the charts. Don't just look at the short term. Don't talk about what happened in the last 5 minutes or even the last 5 days or weeks. Look at the multi-year chart or even the multi-decade chart, depending on your time frame, and say, okay, we got that long basing process in 2018. We just had a breakout. I don't know if you're a chart guy, but I'm a chart guy as well as a fundamentals guy, and the chart it looks textbook. It looks picture perfect for buying gold. And again, if you want some leverage, get some silver too. Get some gold miners if you're into that sort of thing, which I am. I'm not huge on stocks, I'll admit that right now. But if you pick and choose, you can get that nice leverage. Take a reasonable position. Position sizing is what it's all about. The higher the risk, the smaller the position size you're taking. I'm not putting 98% of my portfolio into gold miners. I've got a lot more gold and silver than gold miners. I'll admit that. I like the tangible assets, but you can mix it up. You don't have to have your entire portfolio be defensive. You can go on the offensive as well. You can have a
Exactly.
mix of both. That's true diversification. Some higher risk assets, some lower risk assets. As long as you don't have toxic assets like bonds and the dollar, you should be all right.
Exactly.
Yep.
Oh, well, David, this is great. This has been a really great conversation. And I really appreciate all your time. And once again, all the reports that you guys put together, they're all free. And you can find them over at portfoliowealthglobal.com. All the links to the reports that we talked about, they'll be in the description box below. And David, is there anything you want to leave the audience with this afternoon?
I want people to subscribe to your podcast. That's very important. If you're just listening to this casually, hit that subscribe button. Man, Rory Hall, he is. You are my main source when I'm looking to what's going on in precious metals and the miners and the economy and the bonds and the dollar and the stocks. All those, you are my go-to. And so people subscribe to. Yes, go over to portfoliowealthglobal.com, get the newsletter. You're going to get those great picks from us. But also, and check out the reports, but also subscribe to the podcast you're listening to right now and get those notifications so you'll be on top of things. Don't wait for us to come to you. You need to come to us so you can stay on top of what's going on.
Well, I certainly appreciate that, David. I really do. That means a lot to me. And we'll get you back on before too long and get an update as to what's going on with all this craziness that's floating around that we're all wading through. And I really appreciate it. And I look forward to speaking with you in the not too distant future.
Thank you, sir. Appreciate it very much.